Today we're going to talk about level 1, level 2, and level 3. We're going to review yesterday's trades. We're going to go over some questions that came up from yesterday and over the weekend. Stay tuned, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. The market not letting us down. Yesterday we had some tremendous moves on breakouts of day zero or smaller rectangles off the lows of the week on a couple of the pairs, pound yen in particular. A couple of traders sent me some screenshots. They held on for pretty much the whole entire move. Congratulations, big day. Today we're going to review level 1, level 2, level 3. We'll talk about day zero again, the narrow range days. We're going to look at yesterday's trades and break them down. A couple of questions again about the M's and W's. We're going to talk about 50 pip boxes in Asia. So when the Asian market moves more than 50 or more pips in that early session, how do we approach that market? So certain traders have understood that we just redraw our highs and lows, but we'll look at some examples yesterday and we'll look at how the market set up with the numbers and how the market worked into levels to form M's and W's to complete those moves before moving back in the other direction. So another question regarding the M's and W's was how often do I see them, or what, in my perspective, what percentage of cases? Pretty much every single day. One of those two sessions will have at least one or the other. Typically, if you understand what that's doing, that's usually going to anchor in the low peak formation or the high peak formation. Assuming that that day has both of those in place, we will usually see an M and a W of some sort, whether it's an extended version, a shortened version, a three peak reversal, whatever that may be, but we'll usually see one rendition of that M or W formation. So just understanding what that represents. That is when they're locking in that peak formation, trapping volume above or below a level before shifting it back to either hunt stops or to continue a move in that direction. So just to review our simple system again, structure. Today we're going to talk about day zero again. A lot of people asked about day zero, narrow range day. I'm going to just show you an indicator that I put on my daily charts. It's a free download. It just designates on my charts, I can look at all the majors as well as the pound crosses or any pair that you want to follow to look for those narrow range days. Typically we will see them when they're down low from a previous week or the beginning of a week, or even towards the end of a month, whatever that may be. We'll see a narrow range day, and what that's doing is typically trapping volume down in a lower level or in an upper level, and we'll see those on level 3 as well, which we'll talk about today, as we may be seeing some of that play out as we head into our Wednesday midweek, potentially midweek reversal, midweek continuation opportunities. So structure is just the geometrical. Doesn't matter what shape I look at, whether it's a head and shoulders, a descending triangle, an ascending triangle, double top, double bottom. To me, that's a rectangular box. It could be 25 pips, it could be 50 pips, it could be 100 pips. So again, we're going to look at some examples of how to use 3 levels of rise or fall each day to understand how that can play out and allow us to identify the number levels of where a market may be starting to end its move or where it's working back into a level. We talk about day 1, day 2, day 3. The easiest way to remember that is Monday, Tuesday, Wednesday. So I start the week fresh every week. That zero range day could be on a Friday, it could be on a Monday, it could be on a Tuesday, it could be at the low of a Monday, the beginning of a Tuesday, or vice versa for the peak formation. It's typically when a market is going to lock in a level, put a peak formation in place, or trap volume over successive pushes without going any lower and then breaking above the last high before the low or below the last low before the high. That's the easiest way to understand when that level 1 may be beginning. So to me, structure, regardless of the pattern or anything else, is usually a rectangle. So we can have a 25 pip box where the market is successively trapping in volume before it reverses out. And again, we'll use the numbers. This may be a 50 pip day. We could have had higher peaks in here somewhere. They may have brought it up in London and been selling it down, catching traders shorting that market as we saw in the British pound, and then working into a lower level before reversing. But again, the numbers can start to play a bigger picture, because that can tell us, is the market trading in 25 pip increments for 1 level, 2 levels, 3 levels of rise for a 50 pip box? So they may come up and put wicks into that upper 25 pip box and be trading back down in a 50 pip box. Or as we saw in the pound yen, they may go above the 50 pip box and work it down into a quarter level for a reversal on top of 50 for that continuation of 50 pip levels of rise. And that market failed in the upper 50 pip box at the round numbers. So we may be working with 25 pip levels, and on a normal day, typically we will be working in 25 pip levels of rise and fall. So again, we talk about identifying the Asian range. The Asian range may stretch out over 50 pips, but they may work down below a level and pop it back up and then break out. So we have 1 level, 2 levels of rise. They may work it back down in the US and then continue it up for that 3rd level before bringing it back down to stop hunt the traders from the London session. We're going to look at some examples from yesterday, but again, 3 levels of rise or fall, that happens every day. And they, again, just to reinforce, they could work it up 25 to sell it down. That's 1 level up, 1 level down, pull it back in the US and then drop it down for that 3rd level. So we may only be in a 50 pip box, again, maybe on a day 0, or up high if they're trapping traders up at the top. But that each session, the amount that it moves can give us an indication based on the round numbers. Are we trapping volume down low for a move up, or are we trapping volume up high? Have they extended it out? We'll see this often on a peak formation at a weekly high or a weekly low, where they'll move at 25, 25, and 25 before reversing it off that 75 pip level. We're going to look at some examples of 50 pip boxes in the Asian range, because there are different scenarios, but when that market moves, you can look at the last hour. If the Asian session has moved more than 50 pips, you can look at that last hour between 1 a.m. and 2 a.m. New York Eastern Standard Time as a potential area time frame, especially if it's at numbers, where that market may reverse, consolidate and reverse before the beginning of the Europe session. So they may actually move it 25 pips before the Europe session opens to continue that move. So if the market moves more than 50 pips, they could move it up into consolidation for a trade, a straightaway trade. But if they move it through the numbers as they did yesterday after a breakout of a previous day's day 0 range, you can expect to see a move back through to retest the high. It doesn't have to go through, but if it goes through the numbers, so if the market goes above 0 and locks in and comes back into a quarter level, you know that there's stops above the numbers and above the round numbers, above the high of the day and above round numbers. So if they go back up into this double 0.50 pip box, chances are they're going to continue at least to the next round number. So again, we'll look at some examples. The pound Swiss was a great example of where they traded up to the high of the day at numbers and pushed up into the upper quarter box before reversing in the US session. Very important to take note of the numbers and where the highs and lows are, because that's going to give you an idea if the market, if it's going to retest those, it will probably continue through that 50 pip box. Okay, so we'll just review the day 1, level 1, level 2, level 3. So I talked about day 0 being that narrow range day before the market breaks out, and again we'll have a lower high before the last low. So the last high before the low, the overall low will have one last swing high. When the market breaks through that, that will typically be level 1. That can happen all in one day. It may happen the next day. So we have level 1, and then the break of level 1 will be level 2, and that could be again the end, the same day. We could have level 1 and level 2 in the same day, but typically again day 1 to me is Monday, Tuesday day 2, day 3 Wednesday. So as we saw, we had a Monday, we had a narrow range day, we broke out yesterday on most of the pairs, we trended, but then we also came to a potential level 3 on a few of the pairs. So we had our pullback in the London session, and again somebody asked me about M's and W's, how often do I see them? Okay, a great example, pound Canadian, the different ones, they all showed similar patterns. We're going to look at these, but the market came back, and again it put a low in place, so we had a high in place, and then we had a low in place. The London candle was a bear pin hammer at the numbers, at round numbers. The second candle, so we already had a bull pin, I think the last candle of the first hour, which we'll look at, but then we had a bear candle follow through at the second candle of the London hour. So coming back to my original statement about the equities hour will often be the trapper trade. This market came back from a high, it went through the numbers, came back to the next round number, bear pin hammer at the numbers in the equities hour at the opening candle. Traders short the candle. We get a bear candle that goes through the low. We'll put it there. Okay? And the third candle of that second hour immediately engulfs the second bear candle. So what we need to understand is that possibly could be the trade, but what we now have in place is a low. We have a low of the day in place. So obviously the Asian low was over here, but we have a new low and we have a new high. So the question now is, do they go straight back up to the high and work the high? So if they went bang, 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 they might be working the high, which of course could mean that we're going to get that sort of scenario. But what they did was, they came down, they gave a low, they came back down again, and then they gave another spring candle for the long trade. And that layered, okay, again we talk about structure, that pin from the London hour, that bear candle pin, now becomes a level, 1 push, 2 push, 3 pushes that they sit on top of, because all of that volume is trapped below there. And again we'll look at the example, but we were working the new low of the day. We worked it, we get our W, bang, gone. Back to the next set of numbers. The US session, we saw 3 peaks on several of the pairs, 33 trades. A bunch of traders emailed me 33, 33, 33. They saw 33s everywhere. So today being Wednesday, we're going to look at those examples because we may have some peak formations in place now, and we have some markets that have consolidated underneath of that broken neckline. So we get this 3 peak pattern, and then we've gotten a break of this structure, and the market is trading sideways underneath. So this could become a nice coiled up market that could end up going down, or as we saw on the pound yen, the market bang straight away took out the highs and maybe has put a peak formation in place. But again, we will see how that sets up as we head into Europe. But we'll look at some different scenarios. It's day 3. We could be on level 3, which typically, again, level 3 will often take traders with the technicals, getting them following up into the top level, so that the trend traders are following their trend trades. They're getting these trades. The market will stop hunt aggressively down, usually through the first peak formation, come back up, get traders chasing that again, and often trap that volume up top. So we hit stops on both sides before the market shifts and consolidates underneath of that peak, and usually it will be in a 25 pip box. So again, you should start to be able to identify seeing this volume and draw a line and see volume trapped, that when this market shifts underneath, that's why it will pull away quickly, and those are the days that you do not want to counter trend, because they will not come back. Just like yesterday on the pound yen, that market came out of a massive consolidation from Monday. When they break out and they trend like that, those are straightaway days. They will not come back. So if you counter trend them, as some traders may have found out, that can be a big mistake. Easier to just be in the trend. They're always in days. They very rarely come back until maybe the end of the session. So again, we'll look at some examples of the Asian range being outside of 50 pip boxes. Again, these are great trades, setups, or days to screenshot and keep your notes on, because you're going to see them again. 3 levels of rise or fall. That can be 25, 50 pips, and in some cases 100 pip boxes. And we've seen that back when the volatility was here in March and April. We saw several of the pairs doing 300 pips or more in each and every day. Another question, how often do I make mistakes? I make a lot of mistakes, but again, as I mentioned yesterday, one of the most important things that I focus on is maintaining my psychological capital. So when I'm setting up, developing my thesis for each pair or making my notes, whatever that may be, I'm not trying to trade every single setup. And some days I may look at the market, it may be very erratic, and then in retrospect see some obvious stuff, but I'm happy to wait maybe for that 3-hour window to evolve. So again, I may not see anything that looks textbook perfect towards the end of that Asian session. And some days I'll have a thesis and then it completely goes the other way. So one of the questions I always ask myself is, what would the opposite scenario be of what I think is going to happen? So that way, one of the best ways to protect myself is, what's my worst case scenario? And one of the things that I really try to never do is get the day zero, be counter trending on a day zero, because again, those are straightaway potential days. So anytime you see big moves like that, and we're in round numbers and 50 pip boxes, that sort of scenario, I always try to stay with the underlying direction of the strength of that market. So mistakes, again, and try to never be angry, revengeful. I'm always focused on talking to myself, keeping it simple, reminding myself we're looking for some simple setups. And sometimes those setups, as we saw yesterday on the W's, they take 3 hours to set up. So, you think in simple terms: 1 push down, 1 hour, 2 pushes down, 2 hours. Or if we put a low in place and then we work it a couple times, that's a couple of hours. So, even six candles is 90 minutes. So you've got to be able to step back, again, remind yourself timing-wise, let the structure develop, let the structure set up, and then remember, when that structure sets up, okay, you can measure this and do range expansion. So if it's a 50 pip box, you're looking at maybe a 100 pip target. And that's the sort of stuff you want to be thinking. And again, the timing. So if the markets move 25 and we're heading into the US session, chances are, and we're below round numbers, that may be the end of that move. So if the market moves 50 pips and consolidates as we head into the 12 candle window, we may be in for another 50 pip run. Those sorts of scenarios. But timing is important. And just again, simple understanding of letting that structure set up can be a couple of hours. So hopefully you got some value out of today's video, traders. Just a huge thank you, a ton of feedback after yesterday's video, a lot of emails, a lot of comments, again, and a lot of traders, like that pound yen, some traders rode that for the bulk of that move. That's a huge day. Those are the sort of days where traders can make a lot of money. So screenshot those trades, make your notes, keep it simple. 50 pip boxes, narrow range days, level 1, 2, and 3, Asia range, 3 levels of rise and fall, and trading mistakes. So hopefully today being Wednesday, again, we're up high, we're at the high of the week on a few of the pairs. We may get some volatility, we may be in a day 3, Keep it simple, let the market show us what it's going to do, and go from there. Have a great trading session, and may the markets go with you.
Good day, traders. Stacey Burke from Stacey Burke Trading. Continuing our discussion on level 1, level 2, level 3, looking at day 1, day 2, day 3, narrow range days, 3 levels of rise and fall, and just looking at some basic, simple concepts with the numbers, the round numbers. So we had Friday. We'll blow this up in a second. This is the pound Aussie. Friday had a big sell-off from the high near the high of the week. We came down, went into consolidation below 8,300. So again, these are the things that you can look at in live time to help develop your thesis. So I know some people come along and they go, well, that's all great. What about the hard right edge? Well, this is the whole point of the hard right edge, is to be able to have a thesis about where this market may be setting up at the timings, at the numbers, and the patterns. Are we looking for a sell high setup with a M formation, 3 peaks? Are we looking for a sell setup where the market gives us a 50 pip box, hits the previous day's low, 3 pushes, 1 push, 2 push, 3 pushes? If this market was going up, it would have been 3 pushes in either to the low of the day or consolidate and extended down another 25. The 3 pushes at the low of the 3-hour Asia high-low window gives a 3-push creeper back 25 pips to the numbers as we head into the Europe-London 12-candle window. The 1, 2, 3 is down into the blue tray, so they pull it back, and the London candle comes back towards the low of the day. Now, traders, again, they make this look like a W, but the stop hunt was back up into the Asian range. They put a peak formation low. We have stops underneath the Asian range. But again, just coming back to what we talked about with the 3 levels of rise and fall. We started the session in the upper part of the 50 pip box. They dropped it down 25. They pull it back 25. So we have 1 level, 2 levels, and then London extends it down into the 3rd level. They try to go lower, but that's where it reverses at the end of the 12 candle window, engulfment for the stop hunt back up. And again, we see the 3 push creeper down in the US session. 1 push, 2 push, 3 pushes. They retest the lows before pulling back and taking out the lower structure. So again, we'll blow this up. So again, we're day 1, but we're in a range bound day, almost 75 pips. But the US session, the fact that it's creeping trend into the low, and we get these lower high structures. This is what you're looking for on a day 0, level 3 type setup. The market is making lower highs, lower highs, lower highs, but it's not going any lower. Then into the close, they break the high, they pull it back, they retest the high of that swing high again before the equities hour, very similar. Again, we talked about that in our whiteboard example. The first hour takes traders chasing the shorts again. So if we had indicators on here, this would be a trend trade. You'd be swing trading that into the low at the open of the 12 candle window. And bang, we get the engulfment reversal for not only a multi-session W, but obviously we have that lower 25 pip box plus where there's trap volume all underneath of the round numbers. So again, just talking about numbers, selling at 50, selling at 50, selling at 50. It's not going anywhere though. We have all this volume trapped, and then bang, the engulfment, which by the way is on a smaller time frame, would be a W. So if we blow this up, we'll come back and look at this. Just move this back over. Okay. That was yesterday. So here we go. On a smaller time frame, of course, we get a W. So somebody said to me the other day, I don't see a W. Well, obviously, the engulfment and the first hour being down, and then the chase bar at the opening of the equities hour, and then the swing candle on the 3rd candle, well, on a smaller time frame, that's a W. The more you see these, the more you're going to recognize that that's a W. The last high before the low. So the low of the day, the low of the week, arguably could be one of these two, but the main peak formation was either the London session, because it doesn't matter. This whole break took out the last high before the low. The last high before the low becomes significant because we're in a box here. The market breaks that and then comes back down. So we talked about markets that move 50 pips in Asia. So sometimes you'll see this market 1 push, 2 push, 3 pushes up high and an engulfment up high for a sell day. This market worked down. 1 push, 2 pushes, 3 pushes, 1, 2, 3 engulfment on the third candle of the equities hour. Again, on the 1 hour chart, this would be a massive pin bar. So we have our engulfment, and again, it's a 25 pips. So some traders have shorted this, okay, thinking that's an M structure. Okay, they've taken that, but that's 1 push, 2 pushes, 3 pushes on the spring candle coming back up. We have a couple things. You definitely would have to be at break even by that stage or taking money off, but the pin of the London candle now becomes a structural box. We have our low of the day pin from the first pin bar going long, and then 1, 2 taking traders short, chasing the move down in the equities opening hour. Then the engulfment. This structure becomes a potential box for a measured move. So the market, again, we'll just lower this down. Okay, so somebody said to me a couple weeks ago, well, you can't do, you put that tool on there, you don't know the market's going there. Of course I don't. But if I'm in the trade, that's potentially where the market may be headed. Now, it reached one full expansion and hit up to the double zeros. 1 push, 2 pushes into the U.S. session. 3 pushes into the high. We're not going any higher. We're not hitting this upper second full expansion. We are through the round numbers. It hits it a third time in the U.S. session before engulfing the third high bull candle. So we have an engulfment on this first shoulder, but then bang, the market hits it again at the open of the equities hour. So again, the equities market, that hour, gets traders chasing the move into the peak formations, similar to this market, similar to the Asian market, chasing the market in the wrong direction before reversing, chasing it in the wrong direction before reversing, coming off of numbers, going into numbers, breaking through, hitting the high of the day, past the numbers, but not going any further. Okay? Hitting it a third time, engulfing that candle, and then pulling back one more time and consolidating at the numbers. So again, an example of where you have 1 push, 2 push, 3 pushes, and an engulfment where you're filled in the middle of the box, giving traders an opportunity to fight for a better fill. So some traders recognizing this pattern, if they took this trade, could get filled at the numbers. Their worst maximum stop loss would be the high of the day. So if this trade was to follow through and take out that high and fail, your maximum stop loss is still protected. You're still looking at roughly 20 to 25 pips with the spread on this pair. The market auctions back down, takes out the middle structure of that larger upper 3 peak formation from the U.S. session and goes into consolidation at the close. So again, the market has broken through the lower quarter level. This upper quarter potentially now, we'll just color this in. Okay, this upper quarter, we'll make that just a little see-through. Here, let's call it deep pink. This upper quarter may become trap volume. So as we head into today's session, is that going to happen? I don't know. But if this volume is trapped and this market does sell off of somewhere underneath of that 82.75 level, we may be potentially in a day where the market may head back down towards the lows of the week. Now, the other scenario is that this market may have given us somewhat of a W formation already off the round numbers for a break back up above 75, breaking above that middle structure to retest the highs of yesterday. So again, interesting possible setup, but you can see how they manipulate things down. We are underneath of this middle structure. The market has broke down, but again, depending on how we head into that 12 candle window, they may work the high for a sell. They've got traders going long off the lows. They're above that middle structure in the Asian session. If this market was to push up into the numbers and roll over and retest that Asian session low, we could be in for a measured move down and retesting the lows of the week for possibly an even bigger move if we had a trading range breakout of the Monday, Tuesday initial balance. So again, if we were to head up towards the peak formation, 8,300 could be significant, but you can see now as the market jams down lower, consolidates, breaks out, works the high 3 times. We may work back into that peak formation before rolling over. We are underneath the neckline. We'll watch and see what happens. Looking at the British pound, this is going to demonstrate a couple of really great examples of just, again, looking at some structure evolve over a few hours rather than just specifically looking for a trade off of the start of the session on a 1-bar sort of scenario. So again, talking about narrow range, we'll just bring our Monday line separator up again. Narrow range days, we had the big sell-off on Friday and the market basically became an inside bar narrow range day on Monday, British pound. We had 1 push, 2 pushes, 3 pushes into a peak formation for the sell-off on Monday. So again, we talk about our initial balance, our Monday, Tuesday, in a large percentage of time is the high and low, or can form one of the boundaries of the high and low for the week. So again, we can see that we were working the low. The market stayed up high, working 1 level, 2 levels, 3 levels of rise before selling off in the U.S. session on a pin hammer at the high of the day at pinning up to the round numbers for the sell-off back down to the low of the day. 1 push, 2 pushes, and again, our pin structure. I'll blow this up in a second for our lower boundary, potentially for our rectangle coming up, hitting the high, and then hitting it one more time in the rollover, breakout, pullback, continuation. So a multi-session W formation. We'll blow this up. So again, the last high before the low becomes our U.S. session peak formation. The market forms a lower structure, a lower pattern within a pattern. We have another box that the market may break out of. So I look at everything as a box because we have these little structures that form down low and up high after big moves. I'll just reinforce that. And what we're looking to see is how the market behaves around those levels. So in the market, we talked about 3 things markets do. They break out, they pull back, they continue, and they trend. They break out, they pull back, and they go into a trading range, sort of similar to Friday's Europe-London session. Or they break out, they pull back, and they reverse. So again, a breakout pullback reversal, hitting the lows, also potentially a trading range on Friday, but also just the 1 push, 2 push, 3 pushes, giving us the extended W. So there's our middle structure. Again, a gentleman asked about middle structures. Whenever we need a middle structure for this to form some kind of geometrical M or W, triple bottom, triple top, whatever that may be, but that last section on that middle structure is where we can get our geometry from. So this did 1 full expansion up before selling off. And again, the extended M formation before the sell-off. Again, just after seeing so many different variations of this, you'll start to identify. But timings are key. Round numbers, 1 level, 2 level, 3 levels of rise before dropping down. And now we have a 100 pip box. So we get into a 100 pip box. Is this market going to do 300 pips of movement? Well, it all depends on how price behaves when it gets to the tops and bottoms of these boxes. This market breaks out of that lower box, consolidates, keeps breaking out, consolidates, hits the high again. So again, a market that's gone 50 pips or more in the Asian session in that last hour, gives us our peak formation. So again, this market could be working the high, working the high, working the high to sell off. But the market went through the round numbers. It went through double zeros. So what that means is that if the market does head back towards the high of the day at that time, it is going to be in that upper 50 pip box. If the market had pinned up to the round numbers and pulled back, we could look at the round numbers potentially becoming the high of the day. We're in a 50 pip box. The market sells down, one push, two pushes, pins to the high. So again, middle structure. I talk about the structure for the flip zone, and that's different than the middle structure of a W. It's the pin of the London candles, the London hour, when it forms. If it gives us pins on either side, the top and the bottom, if it breaks out of that, that can become our geometry for a measured move. In this particular case, the market does one push, two pushes, pins the high, third push, middle structure. So again, we have our high of the day. It forms the low of the day. It breaks the low of the day, pulls back and gives us a new low of the day. Hits it again, hits the high, works the low one more time before engulfing. We have our middle structure for our W, but we also have a flip zone high of the London hour for that market to consolidate on top of, which is what these pins did on top of that, creeping higher, and then boom, it breaks higher. But we have our measured move now, potentially, for our structure, for our high and low of that London hour. And the market pinned up pretty much to the high. So again, market goes 1, 2. You're waiting for a fill with the spread. You may want to be trailing this up on a smaller time frame, or be prepared to capture that movement, or when the market reverses on that third candle to the high, taking the money off at the round numbers and calling it a day. So sometimes, as you can see, it did a second full expansion, but if you were waiting with the spread, it may not have gotten you filled. But that W, just again an example, 50 pips up, the market comes down, three pushes, forming a W, working down, working down, working down. That's going to form a W. If it was working up, working up, working up, we'd be looking for the M structure. The market breaks higher, pulls back into the U.S. session without taking out the high of the U.S. session from Monday. So the stop hunt was down into the numbers, pin hammer, blowing off through the high of the day, through round numbers, and then pulling back. Third attempt to go higher, dropping down, engulfing, pulling back, consolidating, and again, breaking that middle structure. So now we potentially have a reset, or trapping traders chasing the long into the peak formation. So we have a peak formation. This again may be a trap. We may have volume trapped up high. We have a peak formation in place at the high of the week. The market is broken down below that trap volume. So again, depending on how this market trades, we may get a stop hunt up into the numbers for a move back down. If that's the case, DNC, do not counter trend the peak formation. This could be a big move down. If the market breaks up above the numbers, it could retest the high of that middle structure for a day 3 continuation, potentially into a level 3. Watch and wait. We'll see what happens. But if this market does retest and fail and break that middle neckline from yesterday's 3 pushes into the peak, we could see a market move in 3 levels of 50 pip increments back through the low of the week. Okay, again, we're looking at the pound yen. We had the big sell-off at the high of the week on Friday. So just to go over a couple of things, a gentleman asked me again regarding the M's and W's. Typically, you will often see them when they're peak formations at the high or at the low. Again, just looking at Thursday, we have 1 push, 2 push, 3 pushes, forming a W at the low of the day, but also a larger structural W, which is that retest in the U.S. session. And again, that structure, when we get structure, so we have structure. Heading into the next session, we have structure on the breakout of the London W for a measured move for 1 full expansion. The market fails at 1 full expansion heading into the 12 candle window, which again is an example of where I talked about if you're in a trade and you're heading into the next 12 candle window, you can look at taking money off the table. That market broke above the high of the day and the high of the Asian swing highs, but again, it consolidated at the high and at the high of the first full expansion. In the U.S. session, we now have another structure when the market gives us the engulfment, the 3-bar engulfment in the equities hour for the reversal. We have a larger structure now for a full range expansion of targeting more than 50 pips. So some traders, if they targeted that 50 pip box, it continued with the range expansion up to that second full expansion and then traded sideways into the peak formation of the high of the week, giving us an M structure. And again, you can see how they can manipulate this, bring it up, and then bring it back down again with that middle structure, the big bull candle at the open of the 12 candle window. Thing is, just simple in simple terms, you're selling at the high of the week. That market came back down, hit the lows, pulled back, worked into the peak formation, went into consolidation. We talked about this the other day, drawing the bigger box, and then also the smaller box inside. So we had, again, a typical awesome setup for a potential narrow range day, day zero. The market took out the low of the day, the low of the London session into the close of the session, and then went into consolidation before breaking out at the beginning of the Asia 12 candle window. And again, driving down and before reversing right off the bat in that first hour, consolidating above the breakout, pin hammer for the continuation back towards the high of the U.S. session high. So again, breakout of one smaller geometrical structure, smaller patterns within patterns. Again, Peter Brandt talks about this all the time. If you haven't read Peter's books, get them. They're worth gold. Follow Peter on Twitter. He's got some great charts up all the time, just simple classical charting. But again, the market went up towards the end of the Asian hour, 50 pip move. You can expect to see something happen in the end of that Asian hour. We're up high. The market gives an engulfment reversal. So this does a couple of things. Puts a high of the day in place without taking out the high. At this stage, I would say that there's a high probability these stops are going to get hit. But also, more importantly, we'll blow this up for people to see. It gets people shorting the market. So again, we're in a breakout. Even though we're inside of that larger geometrical structure, we're still inside of a breakout of the Asian range. And that pin, again, similar to the London one that we talked about, that can form a structural high box. So we have, anytime you get pins and they break them, that can become a flip zone. A flip zone is where, for example, this market's selling, they break it, and now potential support. The market sells off at the high. 1 push, 2 push, 3 pushes into consolidation. They hit stops on traders that have shorted it. They hit it a second time. So we have a low of the day in place, high of the day in place, and a low of the day in place. Now the question is are they working the high or working the low? They hit the low a second time, expanding the range, pulling it back, a 3-bar engulfment with a pin to the high. So again, highs and lows, pin bars. Does it fail at the pin, or is that pin now going to become a flip zone? And if it's a flip zone, we can take our measuring tool, put the high and the low in place of where that leg started, and put a potential area of measurement on there. Now, the other thing we talked about was 3 levels of rise and fall. So coming back to the previous day zero, we're in a 50 pip box. They drop it down below the numbers into the lower 25 pip box and go into consolidation. Start identifying the trap volume. Trap volume, getting people shorting the market, shorting the market, shorting the market below the round numbers. We're back inside of a 50 pip box. High probability it will head to the top of that box. It works down 25 pips to the numbers. 1 push, 2 push, pin through the high, 3rd push down, spring candle into the upper 50 pip box. So now we're in 50 pip levels of rise and fall potentially. So this market now goes up to the next 50 pip box and goes right through it. Level 1, level 2, level 3. And what do we see at level 3? 1 push, 2 push, 3 pushes to the high before pulling back, spring candle, and going into consolidation. So you can hypothesize that this trade will probably end somewhere up at the round numbers. Now, day 2, level 2, some traders again may have held on to this, and as we can see, it went higher. Or they decided, again, at the end of the day, they take the money off the table, they lock it in, the market pulls back 30 to 50 pips and goes into consolidation. But just coming back to looking at the levels of rise and fall, the Monday, the market starts off, we'll get rid of this pink box, the market starts off in the upper 50 pip box, the 25 pip box, it goes down. So we're in one level, 2 levels, comes back into the second level, works back down to the top of that lower level. So we're in 2 levels, and then goes up to the third level of rise for the sell-off. 1 level, 2 levels, 3 levels of rise. We're obviously working in 25 pip increments. The next day, we're working in 50 pip increments. 3 levels of rise. So this market potentially now is working the double zeros at round numbers at 140, significant round numbers. We may be in a level 3 situation where this market now has possibly giving us our middle structure. They may come back up a third time to hit that and hitting the gap on the sell high setup. But we may be in a opportunity where we have trap volume sitting up above that quarter level, above 75, and there's lots of room for this to come down. If the market was to break the high again, well, obviously this level 3 may fail, but we have higher lows where stops are below these numbers and below the lows of the U.S. session. The market has given us a M structure at the high of the week, but again, this may be a trap, getting traders to short the market early. If the market takes out those highs, we could be in a reset for a continuation and possibly a measured move. So again, we wait, we watch and see what happens, how they work the high, if they stand underneath the neckline or they hit the double zeros one more time and possibly sell off. Hopefully you got some value from today's video, traders. 3 levels of rise and fall. Day 1, level 1, just coming back to that, we had our break of our last high, the last high before the low. So we had level 1, possibly Monday, level 2, breaking that on Tuesday. This is even possibly a level 1, level 2 on Monday, and a level 3 on Tuesday with 1 push, 2 push, 3 pushes, or level 2 yesterday, and again 1 push, 2 push. We may be in for a third push up towards the highs of the week. Keep it simple, traders. Let the market set up and give us some simple setups. We're up high at the high of the week. We'll watch and see what happens. Again, thank you for a ton of great feedback. Some traders had huge days yesterday. We've just expanded this pair 150 pips. We're possibly going to see some big moves over the next couple of days again. Stay disciplined, stay focused, have a great trading session, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.